Greetings, comrades. When you're asked to evaluate a cash flow statement, I'd start broad and then narrow it down. So broadly looking at this, if we go down the bottom and we have a look at the net result for the quarter, we've had a win. There's a $66,000 surplus for the period, and so therefore then you need to comment that this has improved the firm's cash position. We started off with 88k in the bank and now we're up to 154. It would be useful to benchmark this against the previous quarter to look at trends, or maybe the same quarter in the previous year if we're a seasonal business. Then we narrow down. Arguably the most useful figure in terms of our evaluation is this one right here. Net cash from operating activities. Why is that important? Well, that's the day-to-day activities of the business. So are we getting enough receipts, inflows from our cash sales, our credit sales in the form of our collections from our accounts receivable to cover all of these guys? Our day-to-day outflows, paying off our suppliers, our expenses, etc. This business, again, is kicking goals in terms of the 132k per surplus. We do want to touch on the other two sections of our cash flow. So we've had a negative effect in terms of our investing activities. Why? Because we've purchased a new van. So therefore, we're looking at the long term, obviously replacing the old van. And then we need to look at our financing activities. So they've kind of cancelled each other out in terms of this 1k deficit. The owner's kicked in some capital, but we've reduced our principal on the loan and we've got some drawings there. So the fact that the drawings has resulted in a net deficit in terms of our financing activities might be something to look at.